All right, what's up, everybody? It is July 27th, Wednesday. Got a lot to talk about. First, obviously, the Fed meeting. No big surprise there. They went 75 basis points. I told you that was going to happen. And you don't need me to tell you what the Fed is going to do, because if Jerome Powell has shown himself to be anything, he is a guy that follows whatever the market dictates, okay? I don't think he really understands that the Fed is a monopolist price setter. It can do what it wants. I think the only central bank that understands this right now is the Bank of Japan, but that's a whole other discussion. I've been mentioning that. I'm not going to get into it. Anyway, you'll know exactly what the Fed is going to do on these policy days by simply looking at what the market is pricing. How do you do that? Well, the CME has a very nice convenient tool called the FedWatch tool. If you just Google FedWatch, one word, tool, it'll come up and it shows you, based on where Fed fund futures are trading, what the probability is of, let's say, a 75 basis point rate hike, a full percent, or a 50. And whatever the highest probability is, that's what the Fed is going to do. Now, they don't have to do that, but like I said, Powell, since his, since he began as Fed chairman, that is how he conducted policy. He just looks at what the market expects and he just reacts to that. So it's no big deal. So this 75 basis points, it was totally expected, like I told you that. And it's funny though, because I just saw a lot of commentary on Twitter today from I guess market bears, mostly monetarists, people who are just myopically focused on the Fed and monetary policy, which is basically everybody except for myself and I guess some of you who follow my channel here. But they were so frustrated. You could just see the exasperation in their words that, why isn't Powell crashing the market? They wanted the market to crash so bad, and they were like, we got so much inflation, why is the market going up? Look, I've said it before and I'll say it again. Inflation, deflation, it's really a matter of understanding the effect on the economy. Both of those conditions are just redistributions of income. All right. And the other thing is, when you have people, and maybe you're one of them, I don't know, probably not most of you if you've been following me for any length of time, but if you purely look at the economy through the lens, and if you look at the financial markets through the lens of monetarism, in other words, monetary policy at the exclusion of everything else, solely monetary policy. And that's that's become the thing. Not recently. That's been the thing for a long time, but I've made a lot of videos about how I view monetarism as having come to the point of almost being like a kind of a psychosis, a mental illness. That's all anybody talks about, at the exclusion of everything else, at the exclusion of trade policy, at the exclusion of fiscal policy. I spend a lot of time here, most of my time, educating you guys on fiscal and also what's happening with bank credit. Those are the most powerful drivers of economic activity. Monetary policy is just price setting. And again, we're dealing with numbers here, 2%, 1%, 2.5%, that are really very low. We're not talking about Turkish level of interest rates. We're not talking about Argentinian level of interest rates. So, but you have to understand that this is a psychosis. I've called it a mental illness, and I stick by that. It has gripped economic analysis and investment analysis to the point of being some kind of a you know, it's cultish, it's crazy, and so you could understand if, you know, something is embraced with such a zeal like that, and it's really a very, very minuscule connection to the financial markets. And I'm saying that with all honesty. But when something is embraced with such zeal like that, then the outcomes, or at least the analysis, for the most part, is going to be wrong. Because you're looking at a really small window or really small optic of something that has an impact on financial markets at the exclusion of everything else. So you can't possibly have accurate results and forecasts from that. I understand how it drives behavior, but that just sets up opportunity for people like us that understand the behavior is based on really a lack of knowledge, a lack of understanding, and that sets up conditions that we can profit from. I told you the other day that the market sell-off we had, I don't know, what was it, Monday or something like that. I think I made a video. I said that is not the start of a new downturn. The past couple of videos I've been telling you guys that it looks to me like, and I just looked at it again today, it looks to me like tax flows are starting to slow up. And in particular, I'm talking about employment and withholding taxes. Those flows, you know, and I track those daily, they look like they're breaking down a little bit. Still maybe a little bit too early to tell, but it does look like, I have a chart, I sent it out to my subscribers. It does look like it has broken an uptrend, and so I see that as good. Now, you might think, well, Mike, that, you know, that sounds counterintuitive. Like if employment and withholding tax flows are going down, doesn't that mean that wages and earnings are going down? Yes, because if wages and earnings going down, you're paying less taxes to the government based on lower wages and earnings. Not hard to understand. So Mike, how could that be positive? The whole thing boils down again to the swimming pool. You want that swimming pool to fill up. That provides the liquidity. That provides that's the fuel that drives financial markets. And if you recall, you know, since April, I've been saying, look, we got a problem here because tax flows are exceeding spending flows. And I said, remember, I did one or two videos on we're approaching the event horizon where the tax flow, I think that was in May. I said, I think we're approaching the event horizon where the tax flows almost every day are exceeding the spending flows, with the exception, I said, there's only 4 days a month now with positive fiscal flows. And that was 5 days a month. That was the 4 Social Security days and the first of the month payment days. Luckily, however, July is looking a lot better. We only had 4 negative flow fiscal days. Today was obviously a big, I said yesterday, today was going to be positive because of the Social Security. So if these tax flows are indeed slowing down, and the spending flows, all they have to do is remain steady, okay? Even if they have, you know, we've already seen that they've come down relative to last year. But if they stabilize here and tax flows start to decline, what happens? The net addition is going to go up, right? Because that's spending minus taxes. If the taxes shrink, so that value, the value of that arithmetic goes up. The value of that equation goes up. That's your swimming pool. That's the liquidity flowing in. And I said way back, I said this could either happen, the good way or the ugly way. The good way being, the Congress could cut taxes or they could increase spending. The ugly way was going to be like what's happening now. The economy slows down, wages and earnings go down, and eventually what happens from that? You get the automatic stabilizers kicking in. That's things like unemployment insurance goes up as people lose their jobs and stuff like that. And Mike, you're going to say, Mike, again, how can this be positive? It's how the markets work. Again, it's all about the stock of liquidity. That's what drives things. And so I focus on that. That's what I focus on. And I said the market, first I said a couple of weeks ago, we're going to see the mid-June highs taken out. That already happened. Yeah, I think yesterday or the day before I said we're going to see 42.50 to 45.20 on the S&P and maybe higher than that. But right now, that's my number. And I have been saying that August, remember, we're going to get a big fiscal boost in August with the quarterly interest payment. That's right there is $45 billion. So whatever this month is going to be, will probably come in around $520 billion in leading spending flows. Add another $45 billion onto that, and the net flow is going to be, I mean, we got what, like 140 billion deficit right now. I mean, we're going to have next month is going to be a good month. Now, getting back to these comments I saw on Twitter and the frustration expressed by mostly monetarists. I mean, they really wanted, like, why isn't Powell, basically that's what they were saying. Like, how come Powell isn't smashing the market down? How's he going to bring inflation down? How's he going to... I mean, it's so twisted. I mean, it's kind of like, for me, it's humorous. It's amusing to watch and read. I mean, there's two takeaways from this thing. First of all, number one, it means all of this negative sentiment, it's going to be unwound. So we still probably have a long way to go on the upside just based on sentiment, okay? Number two, it really highlights the lack of understanding, all right? Inflation's a separate thing. I mean, stocks historically have been good hedges against inflation. And I said this, you just have to know which sectors of the economy benefit. You got producers that benefit, you got consumers that don't. So the money shifts around. It's a redistribution of income. It doesn't mean you can't make money in the stock market. You absolutely can, and you should be, if you understand. That's what, knowledge put to use. But some of the comments were really, really like hysterical. Like, if only we took the FANG stocks out of the index. It's a market cap weighted index. That's like the old joke. Like, if my aunt had a penis, she'd be my uncle, right? I mean, like, we only took that out. Or, can you believe what Powell is saying? He's trying to talk tough, and the market's up 500 points. Well, again, monetary policy, I'm not going to say it has no effect. It has a behavioral effect, because you got to understand that's how the mass views things. So they're going to react based on that. But in reality, it has very little impact on the financial markets. The impact is from these flows. These flows are the real money that either drives things or sucks out that buying power. Okay, that's why we had the big down period from mid-April until, May, June. That's why we had that. And I was, as it was unfolding, I was telling you guys this. So that's that, all right? Again, if you want to know what the Fed is going to do, just follow that Fed Watch tool. Let me mention briefly also today's EIA Weekly Petroleum Status Report. We saw another big increase in gasoline demand. I think it was up to like 9.25 million barrels a day. That was the second week up. I think it's like the highest level now in 3 weeks. We saw an increase in distillate demand. That was the second week up. Also, I think the highest level in 3 or 4 weeks. Exports were huge, all right? Crude exports, I think they were almost like 4.3 million barrels a day. Product exports, crude exports, They were up. I forget the number off the top of my head, but they were up big. I'm sorry. Crude exports were 4 point something million. Anyway, net exports, that's total exports of crude and refined product, 2.5 million barrels a day. That is the highest in 4 months, all right? And we had a draw. I think we had something like a 3.5 million draw in crude oil inventories, and that happened even with a 5.6 million disbursement from the Strategic Petroleum Reserve. So remember that these draws from the SPR, that's ending in September, okay? So I mean, we're getting crude oil inventory drawdowns now, even with, you know, they're doing almost 6 million barrels a week of draw on the SPR. So when that ends, woo, I mean, I don't know, but that just looks like a very bullish scenario to me. What else is going on in the? I mean, the oil numbers, the petroleum numbers look strong. They look strong. So yeah, that's it. That's the update for today, folks. Thanks for tuning in. Don't forget to like and subscribe. See you tomorrow. Bye.